Good afternoon and welcome back to the weekly market analysis from October 17th through October 21st. Make sure you hit the like button and subscribe if you have not already, and go ahead and share this video with somebody if you think the analysis is helpful. And I want to start off with, we just got a lot of stuff happening these days, still trying to really take all of it in. But just to start off with, I thought it'd be good to look at the US dollar index. The DXY, as you can see. If you follow me on Twitter, which, by the way, if you want to follow me on Twitter, you can follow me at Mr. J. Thomason. And also, you could subscribe to my newsletter, which comes out every week on Sunday mornings. It is free. But if you've been following me on Twitter, I've been tracking the DXY for some time on these bullish moves. I became a dollar bull back in the early part of October, early to mid-October, and I haven't looked back since, and the trend is still very firmly up. But we are at a really interesting situation here. We had a pretty substantial rise in the dollar in September, and a lot of people are looking at this as a blow off top. Now, I just want to start off by saying my thesis is, if I make this line go away a little bit, my thesis is that the DXY is going to consolidate in this range that I've highlighted. And basically, it's kind of like an area of support, which comes from the top of the bounce from early September. So that's kind of where I think the bottom end of the range is going to be. And I have thought that we would bounce around underneath this range. I initially drew this trend line back when this October 13th wick occurred, and I kind of drew the line pretty roughly. It's just a rough sketch. Well, it looked like over the last couple of days, because honestly, I was willing to, because just to kind of give you some backstory, all across here, I was personally looking for a top between 108 and 115. That is posted on Twitter. I have shared that, and kind of as we've gotten closer, I started to wonder if the DXY would actually get higher than that range between 115 and 120. And with the macro backdrop as it is, or as it has been, I was considering the possibility that it might actually go a lot further. Then we had this price action that came almost parabolic for a few days. And then as we came off, I wondered if this was going to be our blow off top scenario where price would come down, come up to a certain spot and retest, and then just kind of come off like that. And then I thought we would get a test maybe to the low 100s potentially. I thought we might test 110, 111 first, and then get down to like 108, 109. And that in a real blow off top scenario, that's what that would look like. And if you want a good idea of what that should look like, is if you look at lumber futures, and you look back over here. I just realized I forgot to erase these drawings from a long time ago. So anyway, this is kind of like the blow off top scenario, where, as you can see, you get the rise, the parabolic rise. Price comes off, you get a little bit of a bounce of hope, and then it just waterfalls down. And that's what a true blow off scenario is supposed to look like. But on the DXY, that's not what's happened actually. And so just let me put this trend line back up again. What I was looking at was the possibility that the trend may actually be steeper, that maybe these lines were not valid, or at least that bottom line is not valid, and that it's maybe more something like this. And so far, I mean, on today's price action, we are closing just a tad above that line. So I'm going to leave this yellow line there, but I wondered, especially as we started to catch some support right here, or it seemed like we were catching some kind of support right here, and then we started to come up today. But really, either scenario is still in play. We could, going into next week, just come right back up, or we could break down below this trend line, in which case I would just delete it. And it's really of no consequence, because we have the trend is still plenty up, and we have a lot of room to come off and consolidate before continuing up. And I do actually, my bias is to the upside. And part of the reason for that is my Sam's indicator. Even on today's price action, we're still near the middle of the range, a little bit on the under, like in the lower half of the range, and still in a solid uptrend. But just to again, just communicate clearly, I expected that we would have a pretty long consolidation just based on, if you see those little red X's at the top, those are places where price gets so overbought that there's probably an exhaustion of buyers, at least on the upside when it's a red X. When it's a green X, it means exhausted sellers. And if you come back across the previous couple of times that these signals came out, you actually see long consolidations. Like if I just pull up the info line here, this consolidation before you got to a new high, it was 64 days, and we actually pulled back still. So the sustained move above came 92 days later from that spot. And if we zoom in a little bit more and we do the same thing from when we got this overbought signal, this was almost 30 days before we made a stable new high. On this move up here, if you go from this exhaustion move, we get higher after about 32 days, but then the sustained move doesn't happen until 55 days after that. And then even on this move, remember I talked about this in my videos where people were calling out tops on the DXY here in July, and this one was 40 days, and then we retested that level after 60 days, and then got to where we are now. And everyone's still calling tops. And I don't personally, my read on this is that I don't personally think that enough in the macro has actually substantially changed, because the most important thing here is not what the BOJ does or what the ECB does or what the Bank of England does. It's what the Fed does. And I think part of the price action today on the dollar comes from a couple of things. I want to take a look at two specific things. This morning, I don't know where that just went. Sorry about that. The dollar sunk today versus the yen, and I actually pulled up, I'll show you, I can actually pull up here USD JPY. Sorry, I'm doing this in real time. You got this really, really large wick down, over 1.5% move, and from the top to the wick low, was over 3.5%, just a massive, massive move. But that's kind of what happened back here too, in September, back when the yen got close to hit 145. You saw them intervene, and it wicked down all the way to 140. And then it wasn't very long before we got right back up to that level. And what's crazy is this wick from today, it didn't even get down to that wick high from the last time the BOJ intervened. And they can only do that for so long. The Japanese have committed to yield curve control. And so basically they're in a situation like that the yen is just going to continue to depreciate unless they materially pivot from yield curve control. And I just don't see that happening. So the BOJ news today, I wanted to kind of come down here. I want to see if I have it. So yeah, you can see right here, the Japanese government and the Bank of Japan conducted yen buying, dollar selling intervention in the foreign exchange market. Obviously, the Ministry of Finance declined to comment on the matter because, and I wouldn't expect them to comment saying that they were actually doing that, because otherwise they're going to lose basically all their credibility, if they haven't already. And honestly, that would be saying a lot. So that was one bit of news, but it wasn't just the yen, it was also every other cross pair versus the dollar. So I wanted to show you this chart that I have. It's the US dollar versus the other currencies in the DXY basket. And you can kind of see this morning we started getting a very material move down in the dollar about 5:30 this morning. And a lot of that could also be traced to Mary Daly discussing how it's time to start talking about slowing rate hikes. So this is kind of where I was just saying earlier that what we really need to see is a substantial policy shift and that otherwise the macro hasn't really changed, and I mean a policy shift in regard to the Fed. And in this story, basically what came out was that she started talking about slowing the pace of hikes and borrowing costs. And so basically, like, we still have a 75 basis point hike priced in for the early November meeting. But she basically, her comments essentially pointed to the possibility of the U.S. actually having smaller rate hikes than expected, and the market took that as essentially maybe the beginning of a dovish pivot. But honestly, this is kind of par for the course. There have been a couple of different occasions this year, most notably, if you think about back in July when Powell came out and he said, "Oh, we think we're at the neutral rate." Or the long-term neutral rate, and the markets interpreted that as, oh, that means they're going to pause hikes soon. And this is, if you think about it, back in July, we were talking about, oh, the Fed's going to do 50 and then 25 and 25. So like 50 at the September meeting, 25 in November, 25 in December. Well, we got 75 in September, and it looks like, unless something materially changes, we're going to get 75 once again in the November meeting. And what's interesting to me is, and I tweeted about this, is that the market is looking at this like this is news. And honestly, in my opinion, it shouldn't be. Now, it doesn't really matter what my opinion is. It only matters how the market reacts. But what's interesting to me is that the market has been expecting for some time that the Fed was going to slow the pace of rate increases as far as like the percentage increase. And this is not a pause by any means. It's just lowering the speed of the rate hikes. And so you have to think about, well, is the Fed saying that they're going to hike less, or are they just going to spread out their hikes across time? Because if you look at the December Eurodollar curve, or the December Eurodollar contract, it's pricing in right now that rates are going to be somewhere between 4 and 4.25% by the end of the year, which is a whole 100 basis points higher, which obviously does leave room for a December for December to be just 25 basis points, or potentially November, December to be 50-50. But then if you look at, let's see, it's ZQ, I want to say it's K, 2023. If you look at the, I believe this is the May contract, it's either the May or the June contract on the Eurodollar, we're looking at north of 4.75, so between 4.75 and 5%, which is crazy, right? Because that's almost 200 basis points higher than where we're currently at, that the market is pricing in, that rates have to go to. So when you think about this idea that the pace of rate hikes is going to slow, if you want to think about it as like, 6 months from now they're going to get to their highest rate hike, then if they did 75 or if they did 50 in December or in November and then 50 in December, and then that gives us another 25 per Fed meeting until May or through May, that means that we're just spreading out where the rate hikes come in. It doesn't mean that there is a material change in tightening. And I think that's something that the markets are going to have to realize. I mean, if you look at the December 2023 contract, the Eurodollar, so they actually are looking at 4.65, so between 4.5 and 4.75. So the Eurodollar curve is still pricing in a reduction of the Fed funds rate, so rate cuts before the end of 2023. And I think that that's something, again, if you're going to take the Fed at their word as it currently is, then you have to understand that that's not good for where the markets are right now. So having said all of that, on both the yen intervention and also Mary Daly, what we've seen is a pretty substantial bounce to end the week. So we had bounced pretty big on Monday. On Tuesday we were up big and then kind of gave a lot of it back. Wednesday we were up and then gave it all back, and Thursday came down. But then because of today's price action on the S&P, we were up almost 5%. But what I think is interesting, if you look at the economic data that's been coming in, initial jobless claims and things like that, what you actually see when you pay attention to the economic data is that the U.S. economy is still hot, still running hot from a labor standpoint, and we aren't seeing anything materially as evidenced by the 10-year 3-month yield curve, which I actually thought was going to maybe come off and go negative earlier this week, but it didn't. If like we haven't signaled that a recession is coming, so as long as this remains above the zero line, we can't really expect that the recession is coming, or that an actual recession is coming anytime soon, which I think is important, because one of the things that I've thought about for myself is what's the trade going to be over the next 3 to 6 months. And as long as the economy is still hot, then industrials are still a good play as far as it relates to when we have bullish price action. And one of the pieces of evidence that I can see from that is when you look at the Dow versus the other indices. So if you go from, like the Dow made its lowest low on October 3rd, whereas when you look at the S&P came down pretty deeply on October 13th versus October the 3rd. And so looking at the Dow, you actually have an outperformance if you go from the wick low to where we closed today. It's over 8.5% of a gain that we've had over the last 18 days or 14 trading sessions. So the Dow has been outperforming. If you see on the right side, if I pull the change over here, you can see that the Dow actually outperformed, and it has been, other than on I think 2 occasions this week, or 2 or 3 occasions in the last few weeks, pardon me. The Dow has actually outperformed the other indices on a pretty regular basis, and for a while it was interesting, because for a while the Russell was outperforming on the upside, or sideways at least. So you can actually see that we have been kind of consolidating that way. Now on these moves to the upside, on these bullish moves, the Russell is kind of doing what it did a lot of back in June and July, just kind of heading sideways. So that's really interesting, and to me the Dow outperforming is kind of the side effect of really the strong U.S. economy. And then where the NASDAQ, I think part of the reason the NASDAQ is underperforming is because we have U.S. Treasury yields so high. And I do want to call out here, as far as my strength and momentum signal is concerned, we got another overbought exhaustion signal, and we got up really close to the upper boundary of the probable range here, and so very similar to when we got that signal back here. Now, just getting this signal doesn't mean that price can't continue up, but it would not at all surprise me, just like back here and just like these other instances, it would not surprise me to see a material pullback. And so I just want to call that out and be aware of that. And and if that did happen, if yields did come off, then that would be very, very bullish for risk assets, especially the NASDAQ, which, when you look at the strength and momentum signal, has substantially closed in neutral territory now, after having been in bearish on all the equity indices for some time. So I do want to call that out. And then I want to take a look at gold. I feel like I said this back in August, but if you're a gold bug, you're hoping that this is a double bottom. But the same thing happened back here, where I was saying, well, if you're a gold bull, you're hoping this is a double bottom, and it wasn't. So so gold is not seeing any love. I suspect that gold is going to continue to sell down. I think we're going to see below 1614 and potentially below 1600. But I will say that as things move forward, I'm looking for price to kind of start rounding, kind of like that, before the next bullish move. And I don't mean to say that I think I'm not saying it's going to go parabolic, but I think that gold, if you haven't been selling gold from the top, there's no sense in trying to, time bounces and try to chase any momentum to the downside. If you've missed this move, selling to the downside, then there's no reason to try to start getting cute and trying to play this now. Crude oil, we broke out from the trend line. I've been talking about this on Twitter. I think I talked about it in my weekly update before. I had a line right about there, and I thought maybe we would get a retest and a resumption off there. So I nibbled a little bit there, got stopped out, no problem. The next place I was looking was was a retest of the descending trend line, and we basically got that. So that's the spot for the nibble now, and so the stop loss, if you take that trade, is right below that wick. And so what you want to see is you want to see higher highs and higher lows. You want to see this trend line hold, essentially. So that's going to be something I'm going to be watching for in the next week is, do we get follow through back to the upside in crude oil? And then finally, the other thing I wanted to mention is Bitcoin. And I think this is the elephant in the room. There's been a lot made. Let me just show you on the strength of momentum signal. Our volatility range continues to get squeezed into a tighter and tighter range. We actually had a very slight expansion over the last week of the volatility range. But I want to point this out because Bitcoin's not doing anything. And I posted this on Twitter. I just want to tell you, when you have situations where I'm trying to do this live. I don't know if you can hear it in my voice. I'm not excited about the markets right now. Like, a lot of people are seeing this price action and they're getting excited. People are positioning for a bounce. They're expecting a bounce like we had from June into August, or from March, from the early March to the end of March, and into early April. People are positioning for that. I mean, I just had people tweeting or saw people tweeting either at me or to other people recently saying that they're positioned for a bounce. We've got earnings for the mega cap companies coming up next week. A lot of people are expecting earnings beats. A lot of people are expecting that because sentiment has been so bearish that we're just set up well for a big relief bounce. If not, like, there are people on social media talking about this being the bottom, just like they talked about this being the bottom, and just like they talked about this being the bottom. So, I mean, people are continuing to try to buy the dip. Retail continues to try to buy the dip. That's typically not what you see in bear markets. You don't, like, at the end of a bear market, you don't see people excited about buying the dip and talking about positioning for the rally. Usually you see people saying, this is nothing. Like, you see it widely on Twitter. You see, this is nothing and I got to get out. And that's when you see that waterfall. And we just haven't seen that yet. That's my opinion. You may disagree. That's just my opinion. But you have a lot of people positioning. You have a lot of people positioning for this, and you have Bitcoin here, which has been leading markets for some time, and it's been sideways. So I see this on Twitter a lot, where people will talk about Bitcoin price appreciating, and then they'll see equities following, and they'll say, oh, because Bitcoin is going up, that means equities are going to go up too. But then when Bitcoin is doing this kind of sideways thing while equities are coming up, everyone keeps saying, oh, because equities are coming up, that means Bitcoin has to come up. And that's the wrong way to think about it. That's not correct. Bitcoin has been following net liquidity actually pretty well. And the problem that I have with this is, if we're not seeing material upside in Bitcoin, like substantial upside, like, why are we not over 20,000? I mean, like, if you think about it, over the last couple of weeks, the Dow is up 10%, and I know, like, with Bitcoin, you'll look at this and be like, oh, it went up 11%, or it's up 5.5% from its lows. Well, back here, when we had the bounce, when equities came up, I mean, Bitcoin had gotten up as high as 42% on that bounce, but Bitcoin's not moving, and that has me concerned, because I think that right now, because of substantial call buying and put buying and, like, positioning, a lot of people are positioning equity exposure for a bounce, but then Bitcoin's not confirming that. And this, to me, feels like I don't have a good feeling about it. I'll just say it that way. So I would be careful here. You want to be careful about your positioning. Now is not the time to YOLO all in. Call options on Tesla. It's not the time to put in your whole life savings into Bitcoin and, expect that it's going to go up to, 30,000 or higher tomorrow. You just want to be really careful here. It would not at all surprise me, like I've been seeing this, or I heard, I forget who said this, but a macro analyst I heard recently said that, it would be interesting to see what happens if everyone positions for a bounce that doesn't happen. And if this bounce, like if we don't, what I'm watching, let me go to the S&P. That's a better view. If we don't make a higher high, we're not that far. If we don't make a higher high right here than from early October, if we don't make a higher high than that, and I would even argue if we don't break out from this descending trend line, I think that's where we're going to start getting our water falling down. That's just my opinion. So you just want to be really careful. And I guess all that to say, just in summary, as I close for today, the markets are not like, you can't look at the markets today. You can't look at what Mary Daly said today, who is just one member of the Fed and is not even the most influential member of the Fed. You can't look at one person, what they said, and you can't look at one, central bank's intervention and say anything materially about where the markets are going to go with any certainty. At least I have that view towards the upside. You can't look at what's going on and say, oh, well, obviously this is the bottom and we're going to go break out of this and get to new highs. And the simple reason, the simple reason for that is that you have no idea what the Fed's actually going to do. The market is hanging on every single word, interpreting it in whatever way they feel like interpreting it. And the reality is that it's not certain. But what is certain is that the data that the Fed is going off of is showing a strong economy with inflation still strong. And all of those indicators that the Fed is actually looking at, it doesn't matter if you think it's ridiculous that the Fed is looking at lagging indicators. What matters is that those are what they're looking at. And if that's what they're looking at, and if they're making their decisions based on those lagging indicators, then you can't say that there's anything that has materially changed. And as a result, you can't expect that this is just going to bounce or that the Fed pivot is coming soon. And so I just think that everybody needs to calm down and be really careful here. Because, and I would even say be careful shorting here too, because like going from here to here, that's still a pretty good move. And if you were to bounce all the way up to close to 4,000, that's a pretty substantial move. What I would say is, like, and as a reminder, like the sharpest rallies happen in bear markets. And so we've had just this huge amount of volatility. So, as opposed to Bitcoin, the volatility range on the equity indices has been substantially large. Like if you just go back to, even 2021, and you see the probable range to the upside, or like as prices moving to the upside, wasn't nearly as wide as it has been in 2022 with all of this downside volatility. So I'm just saying you have to be really, really careful to either direction. So you have to position for all the possible outcomes. So my positioning here is fairly neutral. I am leaning short personally, but I would consider myself sort of neutral, net short, barely. Days like these, like they're not the best days, but I'm not getting destroyed. And so I think that you have to smartly position for that. Don't try to make it all in one trade. But yeah, that's kind of the update for this week. Thanks for watching. I hope that this was helpful for you. I hope that it's given you something to think about. I hope you guys have a great weekend and stay safe. And I'll see you guys next week.